Good afternoon, welcome to GrainTV. My name's Cody Bills, this is Brock Shimano. Today is November 2nd, Friday for the weekly wrap-up. Let's get right into fire tips, see where we closed off the week. Corn, soybeans, and wheat all traded down this Friday. Soybeans leader to the downside, trading off 32 1/4. Brock, what was the reason for some of this selling?
You know, I think soybeans really met some technical resistance yesterday on the daily chart. We hit that 565 area again that we've been watching over the last couple of weeks or so. We sold off pretty substantially in the overnight session, down about 10 or 12 cents. But once the pit opened today, we actually sold off quite a bit more. I think a couple things driving it was Informa released their most recent updates, and FC Stone also released their updates as well. So I think those coming in above what they had previously and above what the USDA currently has for the corn and soybean yields and production, I think that really drove the market lower today in today's trade.
Yeah, that may have triggered a little bit of selling there on that side. But also we had another important piece of news come out today. It was the export sales report. It didn't seem to move the markets one way or another. Both corn and wheat seemed to come in right around analyst expectations. Beans seemed to beat analyst expectations. But with all of that considered, where does that leave us in terms of the pace that we need to be at to meet the USDA's expectations?
Yeah, if you take a look at this chart that we continue to follow throughout the marketing year, the blue bars are what we see for weekly sales. You can see this week we actually had disappointing sales once again for corn. The red line is what we need to be making for sales to meet the current USDA expectations. So we did miss the mark again this week. We fell behind pace to meet that current USDA expectation by 3.6 million bushels. The first week this year we're actually behind pace, and we fell another 5.4 million bushels this week alone. You know, soybeans, just a little bit different story. We continue to exceed expectations. We're well ahead of pace to meet the current USDA expectations, about 257 million bushels ahead of that pace. But we did fall another 500,000 bushels this week to meet that current USDA expectations due to this bar right here. So we did fall a little bit behind on soybeans this week.
Yeah, and that's actually kind of interesting when you look at where corn is and where soybeans are. When I was looking into the cash market here, I looked at the flow of grain through Lock 27, and what was interesting to me is that this year we have seen a significant amount of, well, a significantly smaller amount of corn flow through Lock 27. Lock 27's it's an important lock. It's one of the further ones south. It's a good gauge of the actual movement down the river for barge movement down the river. And of course, we're somewhere right around half of the amount of corn has traveled through Lock 27 than where we were last year, and really even less than that when you look at the 3-year moving average. So the bottom line here is that we don't have the kind of demand that we have in the past for corn, and it's really affecting basis, because we saw barge rates decline, but corn basis only improved. Barge rates declined actually 19% for St. Louis, and we saw corn only improve 1 penny, where soybeans, where there is significant demand, improved about 11 3/4 cents. So it seems as though soybeans right now is much more sensitive to the barge rates simply because there's a market to ship it to.
Yeah, it really seems like we're seeing the export sales for corn and soybeans trickle back up the river and affect these river terminals, especially for soybeans. It seems like they're really improving basis levels across the country.
Yeah, absolutely. Well, that'll wrap up this week, and thanks for tuning in. We appreciate it. Follow us on Twitter, follow us on Facebook, and we'll see you back here on Monday.